In this video, I'm going to talk about calculating the cash flows for a project. The word for the day is incremental. I'm worried about the incremental cash flows, which means if I decide to do the project, what cash flows will be generated versus if I don't do the project, what cash flows will be generated. The difference are the incremental cash flows. I want to look at those cash flows in three different time buckets. I'm going to look at today, I'm going to call that the initial cash flow, and what we will assume is we're going to pay some costs. These are mainly going to be costs that we'll pay today to get the project started. So let's say that it's going to cost us $50 million to build the plant and get all the equipment installed, so that's at $50 million. If we've already purchased part of the equipment, if we've already built part of the plant, that doesn't count. Anything we've done in the past, that's a sunk cost, and I'm not worried about that at all. So I'm going to leave that out completely. The other thing I may look for here is net working capital. So in order to do this project, maybe we need to have more inventory on hand. So maybe we need to have an extra $1 million worth of inventory. So we'll look for that net working capital here as well. There will also be issues about land that we could put in, and for now I'm going to skip the issues about the land because some little technical details. So let's say it's going to cost us $51 million, excuse me, to get this plant up and going. Those are my initial cash flows. After that, I want to look at what I'm going to call my intermediate operating cash flows. So intermediate operating cash flows, these would be the cash flows in this example from years 1 to 19. Let's assume that this project is going to have a 20-year life. So in other words, whatever we're doing, the equipment, the plant we're going to build, it's going to be in use for 20 years. So we get cash flows year 1 through 19, and then we're going to have a terminal cash flow. And that terminal cash flow will be the cash flow in year 20. If this were an 8-year project, it would be years 1 through 7 for intermediate, and the cash flow in year 8 for terminal. I can make the cash flows different for every year. That's fine. We're going to keep this hopefully as simple as possible. So this is going to have some relationship to the income statement. So let me show you an income statement. Here's an income statement, and I'm going to do something very similar to it. Let's say that my revenues, so I'm going to say revenues were equal to $16,500,000. My revenues are the same thing as my sales. Let's say my costs were equal to $7,425,000. In this case, I don't care if costs or cost of goods sold or operating expenses. I'm lumping those all in together. So whatever the costs there are, wherever you call them, I want to lump them into this one number called my cost. What about depreciation? The way depreciation will work is this. I will take the value of the plant, whatever it costs to get the plant and the equipment installed, up and ready to go, which is $50 million. I will always use straight line depreciation. For these examples, there are other ways to do depreciation. I don't want to worry with them. Real life I would have to, but for now let's keep it as simple as we can, and I always use straight line depreciation. So I take that $50 million, divide by 20 years, except that plant still has some value, the equipment still has some value 20 years from now when this thing is over. That's my salvage value. So 50 million minus 3 million. My depreciation is going to be $2,350,000. So depreciation is going to be $2,350,000. My next thing here is the interest expense, but I'm not going to bother with the interest expense. Here's why. Interest expense comes about if I borrow money and or sell bonds. So I'm paying interest on those borrowings, right? And I'm able to deduct that from my income or my operating profit before I pay taxes. It shouldn't matter to me when I decide to accept or reject this project if I'm borrowing money to get the $50 million or if I'm issuing equity to get the $50 million. So I'm going to ignore that interest expense for now and think about this for now as an all equity deal. We'll deal with those issues a little bit later. So I need to come up with what the taxes would be if there were no interest expense. So I do this math, and this is going to be $6,725,000. $6,725,000. Then I pay my taxes. Let's say the taxes is 40%. So this is my taxable income. I know you can't read that, but taxable income. I subtract my taxes. So 40% of this number is $2,690,000. So doing that subtraction leaves me with $4,035,000. Depreciation is not a cash flow, right? Depreciation is just something I subtract to come up with my taxable income to count my taxes. So add that back. That's $2,350,000. That adds back to be $6,385,000. So let me show you a shorter formula for that. My operating cash flow should be equal to my revenue minus cost minus depreciation times 1 minus the tax rate plus depreciation. This is just the shorter way to do it mathematically, but think what you've really done here. You said revenue minus cost minus depreciation. That is this number right here. Then you said I need to subtract my taxes, so you took that $6 million, $6,725,000, which was revenue minus cost minus depreciation, multiplied by the tax rate, and then you add depreciation back. So that is the same thing as this if you just did the algebra. Okay, so now we're ready for the terminal cash flow. The terminal cash flow will have the $6,385,000 that we had as an operating cash flow, because what I'm saying is, look, we get everything, we buy everything we need, build the plant, get the equipment, everything going into the first year. Then every year after that, for some number of years, let's say 20 years, I run this project. I'm producing stuff which has a cost, I'm selling stuff which is my revenue, I'm producing the operating cash flow every year until the last year. And in the final year, a few things happen. I get the net working capital back. Maybe. It depends on the project and on how things work, but usually I get the net working capital back. You have to read the assumptions carefully. So that $1 million of, let's say, inventory I had to put into the project, I get to take that back out. There's some value, the salvage value, this $3 million, whatever that plant and equipment is worth at the end of this, I get to sell that for $3 million. So my terminal cash flow would then be $10,385,000. So now I have calculated the cash flows I need to. Here's cash flow 0. This is cash flow 1 through 19. This is cash flow 20. At this point, I can find the net present value, and I can find the internal rate of return.